Hello and welcome. I'm Pooja Sarkar, and you're watching from the Bookshelves of Forbes, India. Today is our final episode of our first season, and we are absolutely delighted to have Mr. Vivek Kaul discussing Dr. Viral Acharya's book, Quest for Restoring Financial Stability in India. Now, the book came in sometime last month, and we've had Dr. Viral Acharya discuss his book with us. But I thought, who better than Vivek Kaul, who has also recently written on the Indian banking system and NPAs. His book was called Bad Money, and the book has been an absolute bestseller for you, Vivek. So I just thought, you are the best person to speak and discuss about another book on banking. So here we have today Vivek on our show. Thank you so much for doing this, and I'm absolutely happy that you're back on our show.
Thanks, Pooja, for having me.
Great. Now, the first thing I wanted to understand, in the chapter on NPAs, I'll just straight go right into the book. In the chapter on NPAs, Dr. Acharya has written that, recognizing losses just ends up being a strategy of kicking the can down the road and leaving them as legacy assets for the next management to deal with. What does he really mean by this? And also, we have been seeing it for the fact in the Indian PSU banking system, at least, that a manager does not want to really take any call because what if tomorrow there's an action taken against them? So passing the can down the road has been the best that managers have managed to do in PSUs. What is your view on it?
There are multiple points here. Now, the first point is that CEOs of public sector banks, unlike the CEOs of private sector banks, do not spend a lot of time at the top. So, if you take even some bank like an SBI, the CEO typically spends around 5 years at the top. Whereas if you compare it with something like an HDFC bank, HDFC bank still from its inception has had just one CEO who retires next month. Even in case of other private sector banks, these CEOs have a longer tenure at the top. So the fact is that given that the CEOs of public sector banks have short tenures at the top, they really don't want any trouble while they are there. They just want to sort of enjoy their time at the top and then retire peacefully and then make some money by joining boards of private companies all across. So nobody wants any trouble. So basically what happens because of this is that the banks are all looking at ways to essentially kick the bad loan can down the road. So if you look at the period between 2011 and 2015, when the bad loans in the Indian banking system actually built up, the situation reached a stage where restructured loans were greater than bad loans. So which basically means restructured loans are loans wherein you have reduced the interest rate or increased the tenure or postponed the payment of principal for a while and so on. So restructured loans essentially reached a stage where they were more than bad loans. So this was essentially, PSU banks kicking the can down the road because no one really wanted any trouble while they were at the top. Now, the consequence of this was that when in 2015 the RBI cracked down on banks, the bad loans in the system suddenly shot up. Now, this did not mean that these bad loans suddenly started to happen after 2015. They were always there. It's just that the banks hadn't recognized them.
True. Now, in a 2016 interview, Dr. Acharya had said that once you have the name of the country on a state or a state's name in the name of the bank, for example, when we see a State Bank of India, the depositor knows implicitly that the bank is very safe. Now, that has been the perception always that I remember in your book also, you have given this very clear example how people had run away from Yes Bank, depositors moved away from Yes Bank. But if you see the other banks, the state banks, which even had higher NPAs, still continue to have depositors. And his book, he further continues to write that, ironically, the presence of a large safety net of deposit insurance and state ownership, which ensure that there are likely to be no bank runs, end up eroding any disciplining force that gets the bank health restored. So basically, I mean, what does he really mean by that? And how do you see this entire issue of people trusting these state banks? It is as if the way, as we always discuss, how people trust LIC just because, the front page
Hmm.
says the sovereign has bagged your paper.
Right. So, you know, essentially, if you look at the names of public sector banks, so you either have the name of the country, which is India, in them, or you have name of a particular state. So you have State Bank of India, Central Bank of India, Union Bank of India, Bank of India, or you have Bank of Maharashtra. There used to be the State Bank of Travancore, State Bank of Hyderabad, Punjab and Sindh Bank, Punjab National Bank. So what happens is, because of this, there is this thing in the head of the depositor that okay, all these banks are backed by the government, and because of that, whatever happens, they are very safe. This is something that, it's a question that I keep asking myself over and over again. Take a bank like an Indian Overseas Bank or IDBI Bank. Now, these banks had non-performing assets or bad loans of more than 20%, even more than 25%. In fact, IDBI Bank had bad loans of close to 30 to 33%. So despite that, people continue to have deposits in these banks. And the reason was because they thought that the government is behind these banks. Now, what that does is that it essentially leads to a situation where the banks do not do the right thing. Now, how does that happen? Now, if there is a fear of depositors withdrawing their deposits, and it is ultimately deposits which fund loans, banks would make a sustained effort in order to ensure that the loans that have been defaulted on are recovered to a large extent. Now, because there is no there is no bank run, and because the deposits continue to be with these banks, what happens is that the kind of effort that is required to recover a bad loan is not made. The second thing that happens is, obviously, the banks know that the government won't let a bank fail, so the government will continue recapitalizing these banks. So in fact, just before, I think yesterday or day before, it was announced that the government is going to put 20,000 crores more into public sector banks. So this is something that has been happening over the years, and lakhs of crore have gone into the public sector banks to ensure that they continue to be in operation. So because they are government owned, there is no incentive for public sector banks to essentially chase defaulters. So which is what Dr. Acharya means here.
Okay. And why is it that banks which are in trouble keep giving out these riskier loans? I mean, if you look at the NPA numbers, it is these state banks which have continually been giving out these
Hmm.
risky loans to corporates and larger corporates.
Yeah. So essentially, see, I can give you a football analogy and I can give you a cricket analogy, or in fact, I'll give you both. So the football analogy is, and I hate the sport, but I do understand a little bit of it.
Oh, I love
So
football.
so what happens in football, and you must have seen this, that when the time is about to run out, and a team is trailing, let's say 2-1, and the goalkeeper has to take a goal kick. He typically does not pass it to a player around him, but what he does is he kicks it with a lot of passion, and ensures that the ball lands deep into the other team's half. And the hope there is that this guy, some of his some other player of his team will get the ball and be able to score a goal. Now, obviously, this is a very high risk strategy, but it's a high risk, high return strategy, right? A similar analogy in cricket would be that, let's say you're playing a 50 over game, and the team batting first has scored something like a 375, or a very high score. Now, one way to play the game would be that you bat out the 50 overs and you end up with whatever 300, 325, and lose the game by 50, 60 runs. The other way to play the game would be to go all guns blazing from the first ball, and who knows, you might just end up chasing the score down. But the problem with that strategy is that you might also end up being something like a 220, 225 all out in 30 overs, and end up losing by a larger margin. So a similar sort of thing happens with public with banks, where which are in a mess. So what they try to do is, and Dr. Acharya explains this in his book beautifully, where he writes that there are two ways. One is evergreening of existing bad debt, throwing more money after the bad so as to help the borrower repay the past loan. So essentially what you do is you give the borrower a new loan so that he repays the past loan, and there are no NPAs. So now you have a new loan, and then the new loan can be a problem, a few years later, or a problem for someone else. Now, what you've done here is you've not acknowledged the true quality of the loan and simply kicked the can down the road, something that we just spoke about. The second thing that happens is you give out risky loans in the hope that you'll get higher returns, and that is essentially a last-ditch effort to rebuild capital quickly. Or as Dr. Acharya puts it, doubling up bets in a casino when the first round of gambling has has all gone sour. So, in fact, there is since we've spoken about football and cricket, there is a similar strategy even in American football, and they call it the long bomb strategy. And what happens there is similar to what happens in football. And there's an economist called Frederick Mishkin, and he writes in a paper called The Economics of Money, Banking and Financial Markets, and he says that when a football team, and by this he means American football and not soccer, is almost hopelessly behind and time is running out, it often resorts to a high risk play, the throwing of a long pass to try to score a touchdown. Of course, the long bomb is unlikely to be successful, but there's always a small chance that it will work. If it does not, the team has lost nothing, since it would have lost the game anyway. So that's what's happening here, Pooja.
Okay. Now, one of the things that RBI came to be known under Dr. Urjit Patel and Dr. Acharya was the PCA, that is the Prompt Corrective Action framework of banks. And as Acharya writes, undercapitalized banks could be shown some tough love and be subjected to corrective actions like the revised PCA guidelines. Also, the fact, if I am not wrong, while reading Mr. Patel's book, I remembered there was this line where he did not mention the name of the book, but he clearly said that the government comes in and there are some newer rules that are brought in, or somehow the bank which is not supposed to slide out through the PCA actually was able to slide out. So these are some examples that they both have shared, and also they both were there at the same time. Can you explain this in some detail for our listeners?
Sure.
This is something very important.
Right. So, Pooja, I don't know how many old movies, black and white movies you've seen, 50s and the 60s. Now, there used to be this recurring theme in these movies where, the hero would be unwell, and the doctor would tell the hero कि इन्हें हवा पानी बदलने की ज़रूरत है, something like that. And the hero would promptly land up at a hill station and fall in love with the गांव की गोरी. And there are multiple films up until the late 60s which have had this track. Now the point here is, why am I using this analogy, is that the hero had to go to the hills in order to heal himself, right? So along similar lines, the basic idea under the prompt corrective action framework was to allow a bank to heal. So essentially what you did was that the banks, there are complicated rules around this, but I'm sort of making this simple for the audience to understand. That the banks are not allowed to sort of give out fresh loans, neither are they allowed to take on fresh deposits. So you just sort of put them in a hospital and allow them to heal. Now, Viral Acharya actually, he discusses this in his book, and he says that such action should entail no further growth in deposit base and lending. for the worst capitalized banks. This will ensure a gradual runoff of such banks and encourage deposit migration away from the weakest banks, public sector banks, to the healthier public sector banks and private sector banks. I obviously, in my book, I looked at data and sort of came to the conclusion that something like this happened, and the banks were in the process of healing, but then the government sort of took them out of the PCA framework quickly. I mean, this is after Dr. Patel and Dr. Patel quit, and Shaktikanta Das took over. Now, also, what basically, what essentially is happening is an efficient, and as Dr. Acharya says, an efficient reallocation of credit uh, for the real economy with a financially stable distribution of risks across bank balance sheets. Now, what this means in simple English is the fact that banks which can take on the risk actually take on the risk, and not banks which cannot take on the risk. So this was one of the good things that happened, I think, between in 2017 and 2018, and is responsible for to a large extent for the revival of public sector banks, whatever little revival has happened. I mean, along with the fact that the government has constantly kept pumping money into these banks.
True. I'll just move away a little from the banking system and this question, because when I was reading the book, I felt that he starts by the entire FRBM Act, that the government has been missing the targets of the targets when it comes to our fiscal deficit, and it's been happening for some time now. And he talks about how we have to look at the longer term, and also that the RBI should also be a little independent in its nature to be able to set their own goals. What do you think of that? Because if we look at it in today, I mean, of course, this year has been a washout year, and that's why the government, if the government obviously can't meet the fiscal, the disinvestment numbers, which will still be acceptable. But if we see last year also, the government could not actually meet its disinvestment numbers.
Yeah, I mean, so, and what, right, sorry.
No, that's okay.
Okay. So, you see, here's the thing, I mean, even in the years the government has actually met the target, I mean, it has met the target by doing what in Mumbai language we would call gochi, I mean, to essentially,
Passing, selling to each other.
In a sense. So what, see, I'll tell you, one of the most basic things about government accounting is that unless money leaves the government account, unless cash actually leaves the government's account, it is not recognized as an expenditure. If unless money actually comes into the government account, it is not recognized as a receipt. So how does the government meet its fiscal deficits? I'll give you an example. You get ONGC to buy HPCL. Now, what happens because of that? ONGC buys HPCL, pays the government some 37,000 crore. In the process, it ends up using its own cash. It also ends up taking on debt. Now, if this thing hadn't happened, I mean, a government company buying another government company, the debt that ONGC took on would have ended up on the books of the government. But through this way, the government essentially ensures that the debt doesn't end up on its books. Or take, a much bigger problem, take something like a Food Corporation of India, which essentially buys rice.
The off-budgeting that happens.
Yes. So the off-budgeting that happens with FCI is that, when the Food Corporation of India buys rice and wheat directly from the farmers, and it sells it at a very subsidized price. So obviously the difference the government has to compensate for. And it never does compensate for the huge difference. So, I mean, from what I remember, in 2020, 1920, the government had the total bill of FCI was more than 3 lakh crore. And the government probably ended up paying around a lakh crore. So there was obviously a gap of 2 lakh crore. Now, obviously, this 2 lakh crore, the FCI has borrowed from somewhere, right? And it has been given that money primarily because it is ultimately backed by the government. So the debt may not be on the the debt may not reflect in the fiscal deficit of the government. The expenditure may not reflect in the fiscal deficit of the government, but it is there. It's just that it is on the books of FCI. So I think, the first thing that needs to be done, uh, and this is like again a pipe dream, forget before the government actually ends up achieving the FRBM target. The first thing that they need to do is to start declaring the fiscal deficit properly. Some of it has happened in the last budget, but that's also not really good enough. What the government of India needs to declare is essentially the real deficit of the central government, the real deficit of the state governments, and whatever has been a lot of public sector borrowing that happens in the name of the government, and it doesn't end up showing in the fiscal deficit. So what we need to report properly is what we call the public sector borrowing requirement, and I don't think anyone in the government calculates that number right now. So
yeah, that's now, one of the key points that keeps, getting made over and over again in Dr. Viral Acharya's book is that when bank balance sheets are so weak, they cannot support healthy credit growth. How do you explain that?
right. So it's very simple. For every loan that banks give out, they need to allocate a certain amount of capital against it. Okay. So if the capital is limited, by its very definition, lending will be limited as well. Now, this is best visible in the fact that if you look at the overall lending carried out by public sector banks as a proportion if you look at the lending carried out by public sector banks as a proportion of overall lending carried out by banks, in 2010-11, it used to be around 74-75%. So 3/4 of the lending outstanding loans were given by public sector banks. In 2019-20, that had fallen to 57%, 57-58%. So obviously what is happening is that the market share of public sector banks is coming down dramatically over the years, and the reason for that is the fact that a lot of them just don't have enough capital to give out loans. So essentially, this is what is called privatization by malign neglect, wherein even though the public sector banks themselves are not getting privatized, the sector in itself is getting privatized, and this is the impact of essentially banks not having enough capital.
True. Now, just continuing on that line, Dr. Acharya asks in his book that should or can the valuable and sizable deposit franchises be sold off to private capital providers so that they can operate as healthy entities rather than be in a ICO? Is that probably going to work, or are we being just too optimistic that if we give away the good part to the private banks, that'll be safer?
Okay, so here's the thing. This is obviously this is a question that anyone who's written a book on banking has thought about quite a lot, and including me and including Dr. Patel. And the thing is that the people running the government, be it the ministers or be it the bureaucrats, just don't have an incentive to let go of public sector units. Okay, and this is a point that R.C. Bhargav, the grand old man of Indian car industry, current chairman of Maruti Suzuki, makes, and a former IAS officer, makes in his new book. And he says that the administrative ministries have always been reluctant to give autonomy to their undertakings or to privatize them. In some instances, the undertakings are the main justification for the existence of the ministry. Now, to give you an example, very simple example, if you take Air India away and sell it off to someone, now what does, the Ministry of Civil Aviation doesn't have, it doesn't mean anything. Or if you take Coal India away and sell it off to someone, the Ministry of Coal has no value. If you take Steel Authority of India and sell it to someone, the Ministry of Steel has no value. So along similar lines, if you start selling public sector banks, then the Department of Financial Services has no value at all, which is why there is a great resistance to sell public sector banks and any other public sector entity for that matter, because there are a lot of people who essentially would like the status quo to prevail. Also, there's the question of you get how do you organize loan melas? If you look at how the government essentially pump primes the Indian economy, and this is a issue both Dr. Acharya and Dr. Patel discuss in great detail in their books, is that whenever the Indian economy is in a bad state, public sector banks are essentially encouraged to lend and uh, ensure that economic growth comes back. So this is something that happened between 2009 and 2011, when Pranab Mukherjee was the finance minister and India was essentially dealing with a very low growth scenario because of the financial crisis, which had started in the US and then spread to other parts of the world. And because of the excessive lending that happened between that period, 2009 to 2011, banks ended up giving loans which they should not have, and then they ended up with huge bad loans. But then that part of the story came later. But at that point of time, Pranab Mukherjee, by encouraging banks, the late Pranab Mukherjee, by encouraging banks to give out loans, essentially ensured that India grew by 10%, which was like, the whole world was growing at 2%, 3%, and India was growing at 10%. Obviously, we had to sort of bear the cost in the years to come. Now, and it's ultimately, as I said, it's all about incentives. And Urjit Patel actually sort of summarizes it beautifully in his book, where he says, where is the fun in owning banks if control over operations, managing them, and determining their regulation is not possible? Now, what happens because of this is that the country as a whole loses out. Now, the moment I talk about privatization of public sector banks, people, especially public sector bank employees, sort of respond with a lot of sarcasm that, but what about social obligations? It's not, banks are not about profitability, public sector banks, they're also about the government fulfilling social obligations. Now, here you need to sort of make a differentiation with the fact that the government is about social obligations. The public sector banks, public sector entities should not be about social obligations. And let me give you an example to explain this. A couple of hours before we were recording, I checked the market capitalization of State Bank of India, and I checked the market capitalization of Kotak Mahindra Bank. The market capitalization of State Bank of India was around 1.77 lakh crore. The market capitalization of Kotak Mahindra Bank was 2.61 lakh crore. Okay, a difference of around 85,000 crore. What is the problem here? The problem is that Kotak Mahindra Bank is a puny bank in front of State Bank of India. So why does the market not give the right, a capitalization to SBI? Because they know that, the government and the babus are running it, and they'll keep making a mess of it. Now, let's say the SBI was a properly run bank and, had some sort of a market capitalization given its size. So all the social obligations that the government needed to fulfill, what all that was required was that every year you could sell a few shares of SBI, of Punjab National Bank, of Bank of Baroda, and so many other public sector entities, and you could carry out all the social obligations that you wanted to. But obviously, that's not going to happen, because it's about control. It's not about doing the right thing. So.
True. Before I go to the last question, I just want to plug in something. You mentioned Mr. R.C. Bhargava's book that you also recently reviewed, I saw in Mint. Yeah, so basically R.C. Bhargava was on our show from the Bookshelves of Forbes India, and we had interviewed him when the book came out, and it was a very fun interview. In case listeners want to watch it, you can just go back and please do listen to it. He talks at length about his experiences and everything while transforming Maruti Suzuki. Now, coming back to the last question before I let you go, what do you think is the most interesting point that Dr. Acharya is trying to make in this book? Also, because you understand banking far better than a lot of people. What is your view on the book?
I don't know about whether I understand banking far
Yes,
better
of
than
course
other
you do.
people.
You already have a book too, which is a bestseller. People are
But
absolutely happy to read that book. I keep seeing it on Twitter.
that is also, that might just be, the book might have just been written to, essentially turn my lack of understanding into some understanding, Pooja.
But I really hope that when Ms. Acharya sees this video, and also you, I really hope that you guys in the next round look at the retail, some of us, and how retail NPAs are going to blow up in the ecosystem. Because I asked him also in the last question in our interview that what is his view on this entire retail NPA, and he was actually saying that people were paying from their credit, people were taking far more credit than they can afford. So yeah, that is one thing that I would like both of you to
So
look at.
retail, yeah. No, I'll answer that question, and then I'll answer the question that you asked. So retail NPAs are going to be a big problem in the months to come. I mean, there's no denying that. The only issue is how big that problem will be. That, as of now, nobody really knows, because uh, you know because of the RBI moratorium. So and now the Supreme Court is hearing the case, and so once all that's sorted out, only then will we get a clear picture as to how bad the scene's going to be. But the scene's going to be bad. I mean, that much I can tell you. Now, I think the most important point that Dr. Acharya makes in his book, and this is something I've sort of told him also about it, and I've also written about it at a couple of places, but I think it still needs to be made again. And I'll read out a long paragraph, and then I'll sort of analyze it. So he says that on the one hand, the overarching presence of public sector banks, other large state-owned financial institutions, example, the Life Insurance Corporation of India, and state-owned enterprises creates the incentive that the government dominates the central bank and its financial sector policies to affect outcome for the entities it owns and for its borrowing program. On the other hand, the recognition that the government has incentives to influence policies as such, and that it is not at arm's length from regulators, driving the private sector into hyperactive lobbying. Read an overdose of consultations with the government and regulators. This in turn induces an overall culture in the system of putting in place business-friendly policies that are pro-incumbents at the cost of market-friendly policies that encourage creative destruction, asset reallocation, ease of doing business, and new entry. So, and I'll give you an example. So if you look at the way the RBI has treated the real estate sector with kids' gloves, the guys are clearly not in a position to repay the loans, and Dr. Patel says so very, very clearly in his book. And but then the loans have been restructured, and I mean it's been going on and on. Also, I mean, I'll sort of take this argument a little forward, and it's not just about restructuring loans. The fact that the government owns so many of these companies essentially leads to a situation where, one, it encourages crony capitalism, and it also, encourages private companies to demand things which are really not logical. So I'll give you an example. So if you look at the the current loan moratorium case which is going on in the Supreme Court. So one of the problems there is how will interest be calculated. Okay, so basically what has happened is, for the period of the moratorium, people have not paid either repaid the principal or paid an interest on that loan. So that interest obviously has accumulated. Now, obviously, the debate is on how to charge that interest and how much interest to charge. So one of the arguments that the real estate sector made in the Supreme Court was that the interest that is charged on the outstanding loan should be equal just to the interest rate on deposits. Okay. Now, the problem with that argument is that the banks have a lot of expenses other than the interest that they pay on deposits. I mean, they have employees to pay, salaries, they have rents to pay, and so on and so forth. But that's not the problematic point here. The problematic point here is that what is interest ultimately? Interest ultimately is price of money. Okay, I make money and I put it in a bank, and the bank pays me an interest, a price. A bank pays me a price for that money so that I do not spend that money immediately. I postpone my consumption, right? So essentially, the real estate sector is asking the Supreme Court to decide on the price of money. Now, tomorrow, what stops any other sector, let's say banks, to approach the Supreme Court and ask the Supreme Court to decide on the price of homes? right? And let's say the banking sector goes to the goes to the Supreme Court tomorrow and says that the real estate companies need to cut prices and sell their inventory because they need to repay loans, right? So so the point is, all this happens because the government is so involved in all these companies, in the system itself. So it leads to things which, one, it leads to crony capitalism, and two, it leads to very extremely highly illogical situations. So I think this is a point that comes out very strongly in Dr. Acharya's book. So it's not just about the banking system per se. It's about how the government being a part of so many companies and so many things essentially ends up hurting the overall system. It ends up hurting governance itself. So.
True, agree on that. Yeah, but I just wanted to add on the real estate part that you mentioned, and I've been thinking about it of late because I've been writing during the pandemic on real estate. Also, I think banks always had this thing that if the lender is selling at higher cost, and if buyers are going to buy at such a higher cost, I'll be able to, if somebody comes in and buys a house at 2 crores, then I'll be able to lend 2 crores, and I'll be able to make money from that side. I also make money from the developer who's also has taken some construction loan from me. But now that the scenario is different and people have not been really doing sales over the last 4 or 5 years now, shouldn't banks really have taken an approach that, okay, boss, now you have to start cutting down the price, or now let's at least get people to buy the house?
So the problem there is, the money, obviously, that the loans that have been given out have been, been given out against a certain collateral, right? And the collateral is essentially those unsold homes. So if the moment the prices are cut, the value of those collaterals fall. The value falls, the bank needs to recognize bad loans. So we go back to the earlier problem of a public sector banker not wanting to recognize bad loans as bad loans.
True.
So
So
it's all
basically,
linked.
it's a vicious circle which keeps going in circles.
It's all linked, and the only solution here is that banks should be run as banks and not as not as something which need to fulfill social obligations and stuff like that. So
cool, perfect. Thank you so much for your time today, and I'm sure people
thanks, Pooja.
would love to hear more from you. And I really hope I get to get you and Dr. Acharya together one day or on our show in the next season.
I am open. You should ask him. So
Yes, of course, I'm going to tell him today, because I remember him telling me that these days you guys are discussing Kishore Kumar music and old Hindi movies. So I definitely think we should sit together and have a good conversation on Indian banking system and fiscal deficit. Thank you so much for coming on our show, and thank you to the listeners for being a part of our journey over the last 31 episodes. We started on March 4th. This is just the first season, and we will be back soon in November with our second season with a different set of guests and some exciting books. Thank you so much for being a part of our journey. Thank you.